Good evening, traders. Welcome to Money Never Sleeps. Today, we'll be digging into very basic fundamental on options. So, what is an option? Options, we have calls and puts. If you play options, you know it's a very high risk, but also gives you a lot of high reward back. So, for example, you can invest $100 in it. The high risk, you might lose everything, and the high reward, you might get $200, $300, or even $1,000 back if you into the right direction. So what directions do we have? Easy, two directions. One, we have calls and puts. So what is a call? A call is that you know the stock will go up in prices, and the puts is that the stock will go down in prices. So inside the option, here we have four different variables that determines what the price of the option is. So first of all, we look at the volume. Is how many contracts that's been traded on the current day. And we have open interest. It's the outstanding contract. It's meaning that how many people are holding this contract to this day. And if you look into if you have Robinhood, I'll show you in just a minute. So when you trade options, you want to have a very high volume and also very high interest. And now let's look at Greeks. So many people don't know what Greeks are. They're very simple to remember. Delta is the price movement in the stock. So let's say the delta is 0.35. That means every $1 move to the upside or the downside, the option price moved 0.34 cents, up or down. And we have the gamma. It's the rate of change in delta. So basically, if the gamma is 0.1 and the delta is 0.3, you just add those two to become 0.4. So every $1 move on the stock, the option moves 0.4. And we have the theta, the time decay, which every single day, you just subtract the theta number towards your the whole option, the whole contract money. So for example, theta is a 0.8. So tomorrow your contract will decrease by 0.8 cents. If your contract worth 50 cents that day, then the next day it'll be 42 cents because the theta is 0.8. And where Vega is the measure in the volatility. So Vega tend to increase the option prices because we have a very high volatility. It's saying that this stock have a very significant change in prices in the very short term. Maybe today, maybe tomorrow, but in the short term. So that's why the volatility is so high that we are expecting a big move from the contracts. So with Vega, you gotta be very careful. Don't buy anything that's too high, like I'm talking about like 120% or 200% volatility. So this is the basic fundamental of options. So let's take a look at like a live example of what option is. So I'm gonna share my phone screen with y'all, and let's take a look at our SPY options. So here we have a $270 call option on November the 2nd. So let's look at our bid and ask. So people are selling it at 203 and people are buying at 193. So every contract is 100 shares, so it times up at 100. So we're looking at $193 to $203 trading range. Okay, and the mark is when it opened, it was open at that price. And the previous close was at $4.30. That's $430. And for today, or last Friday, the high was 320, the low was 153. And we can look at the volume. We have a good amount of people that's trading this today. And the open interest, the outstanding contracts, about 3,000. And we can see the volatility, which is at 23%. Not too high, not too low. And chance of profit, the chance of this gonna hit 270 is 25%. on November 2nd. Now we have delta. So delta, gamma, theta, vega, and rho. I didn't know the rho here, but anyways. So looking at this, what we learned, every $1 change in SPY will see a 0.34%, no percent, 0.34 cents increase in the ask and the bid, of course. And then we have our gamma. So you add the gamma into the delta. And theta, the time decay. So after today, or after Monday, the price will go down by 23.23 cents. And then of course the volatility is for the contracts. So when you buy a contract, make sure the volume is big so you can sell it, because there are enough buyers in this range looking to buy or sell a contract. And then when you look at definitely the theta, you don't want the time to kill the options too fast. And then the volatility is okay. When you buy a high volatility, and then let's say tomorrow drops a lot, let's say the volatility is 20%, and tomorrow the stock price drops $10, this volatility will die down. Once it dies down, the whole options will become very, very cheap, because there's no more activity in the stock. So why would it be expensive? So a lot of people buy into a high volatility contract, and they're wondering why the next day they lost like 80% of the investment. This is why. The implied volatility is very important in trading options. And that'll be it. Thank you for watching. Have a nice day. See you next time.